All right, let's dive right in. Today, we are cracking open the black box of ESG investing. You know, we see the letters ESG slapped on funds everywhere, but what does that actually mean? How does a big idea like sustainability get turned into a real-life portfolio of stocks and bonds? We're going to walk through the whole process, from the high-level principles all the way down to the final portfolio.
So let's start with that central question. You see that ESG label on a fund. What does that really tell you about the companies inside? How does a manager take a concept like, say, climate risk and translate that into a concrete investment decision? That's the mystery we're unraveling today.
Okay, first things first. A real ESG strategy isn't just some marketing slogan somebody cooked up. It's a serious, structured process. And it all starts with two fundamental things: a formal playbook and a dedicated team to run the plays.
I like to think of it like a Michelin star kitchen. The head chef doesn't just show up and wing it, right? No way. There's a master recipe book to make sure every dish is consistent and amazing. And there's a whole team of skilled chefs to execute that vision. Well, the world of serious ESG investing works on pretty much the same principle.
That recipe book in our world is the ESG policy. And this isn't some vague mission statement on a coffee mug. It is a formal governing document. It lays out the firm's specific approach and, crucially, how deeply ESG is going to be integrated for different types of investments. Because, let's be real, you don't analyze a corporate bond the same way you look at a private equity deal. So here's how that flow generally works. It starts right at the top. The firm creates that formal ESG policy. That policy then acts as the North Star for the analysts who are doing the really deep research on individual companies. And then finally, the portfolio manager takes all that research and actually builds the portfolio. It's a really clear cascade from the big picture down to the fine details.
Now, let's zoom in on the analyst job, because this is where the rubber really meets the road. Take a look at this list. Most of these points are the bread and butter of traditional financial analysis, right? Estimating value, forecasting cash flows, standard stuff. But look at that last bullet point. That's the key. Integrating material ESG factors. It's not a separate checklist. It's woven right into the core financial DNA of the analysis.
This really gets to the heart of it. A modern analyst isn't just asking, is this company good or bad? They're asking a very specific financial question. Something like, okay, how will this company's massive water usage in a region that's prone to drought impact its operating costs, its reputation, and ultimately its long-term value? That's how you turn a principle into a number in a financial model.
So after the analysts have done their thing, the portfolio manager steps in. They're the head chef. They take all that amazing ingredient-level research from the analysts and they assemble the final dish, the portfolio. Their job is to look at the big picture, balancing all the individual company stories with portfolio-level goals like risk, diversification, and of course the overarching ESG policy we started with.
Okay, so analyzing one company's climate risk is one thing, but how in the world do you measure that across an entire portfolio with hundreds of companies? You can't just add up a bunch of annual reports. You need a consistent portfolio-level metric.
And one of the main tools for this is something called weighted average carbon intensity, or WACI for short. It's a pretty slick metric that boils down a portfolio's overall exposure to carbon-heavy businesses into a single, comparable number.
Now, this formula, it looks intense. And, well, it is. But don't worry about memorizing it. The key thing to see here is the level of rigor involved. Just to give you a feel for it, look at the top part. It's figuring out a company's carbon intensity by looking at its emissions, often its direct Scope 1 and indirect Scope 2 emissions, and dividing that by its sales. Then that intensity number is multiplied by how much of that stock you own in the portfolio. The point is, this isn't some vague feeling. It's a standardized, quantitative method.
And that's really the main takeaway from this first part. Robust ESG investing isn't about subjective opinions or just green marketing. It's a systematic, data-driven process that's built on a foundation of formal policy and really, really deep analysis.
So with that foundation laid, let's look at the oldest and maybe most intuitive tool in the responsible investing toolbox, and that's deciding what you will not own. This is what we call the exclusion or negative screening approach.
Negative screening is exactly what it sounds like. It's basically a filter. You decide on certain criteria, certain business activities or practices you don't want to be involved with, and you just remove any company that fits that description from your investment universe. It's a simple but very powerful way to draw a line in the sand.
And this approach has been around for literally centuries, long before anyone ever said the letters ESG. It's really rooted in an investor's core ethical or moral beliefs. It's the most direct way for someone to say, my money will not be used to support this. Now, while the idea is pretty straightforward, the reasons behind the exclusions can be different. They generally fall into three main buckets, and we'll look at a quick example of each.
First up, you've got norms-based screening. This is where you exclude companies that violate widely accepted international standards. Think things like the UN Global Compact on Human Rights or core principles from the International Labor Organization. It's about aligning your portfolio with a global consensus on acceptable behavior.
Next is faith-based screening. This is pretty self-explanatory. Here, investors avoid companies that conflict with their religious principles. The common ones are things like alcohol, tobacco, or gambling. For Sharia-compliant funds, this would also include companies that deal in things like pork products.
And finally, you have what are called idiosyncratic exclusions. These are unique, sometimes very specific screens. My favorite example is that New Zealand law actually requires its government pension funds to exclude any company involved in processing whale meat. It's not a global norm, but it's a specific value that's been written right into the law.
And don't think this is just some niche activity. Norway's Sovereign Wealth Fund, we're talking about one of the biggest pools of money on the entire planet, maintains a very public and very influential exclusion list. When they decide to exclude a company, believe me, it sends a massive signal across the entire global market.
But this all raises a really important question. Is ESG investing just about avoiding the bad guys? Is that the only way to do it? Or is there maybe a more proactive approach?
And that question leads us perfectly into a more modern, more quantitative method. This is one that doesn't just kick companies out, but actually scores and ranks every company based on a whole lot of data.
The difference here is really crucial. Think about it. The exclusion approach is a simple yes or no, an in or out decision. But the quantitative approach, that's a whole spectrum. It scores every single company, and the focus shifts from just avoiding the worst offenders to actively identifying the leaders, the best-in-class companies, and maybe even those who are showing the most improvement.
This is a pretty major conceptual leap. In this world, ESG isn't just a screen you apply at the end. It's treated as a factor, in the same way that quants have treated traditional factors like value or growth or momentum for decades. It just becomes another data point that you feed into an algorithm to build a portfolio.
Well, this naturally leads to the million-dollar question, doesn't it? If ESG is a factor, can we prove that it generates alpha? You know, that it reliably leads to market-beating returns? Well, the answer is it's really not that simple. And this is at the heart of a huge ongoing debate among academics and practitioners. A major problem is that ESG performance often moves in tandem with other well-known factors. So when a high ESG portfolio does well, was it because of the ESG? Or was it because those companies also just happen to be high-quality, stable businesses? Trying to isolate the pure effect of ESG is incredibly tricky. And this is where the data itself throws us a real curveball, which is a big challenge for these quantitative models.
It's a phenomenon that researchers call size bias. And what it means is that statistically, bigger companies consistently get higher ESG ratings from data providers. But the tricky question is, are they actually better ESG performers, or do they just have bigger budgets and more staff to fill out all the questionnaires and write glossy sustainability reports?
Yeah, the simple way to think about it is just this equation. A bigger company has more resources to dedicate to disclosure, and that often leads to a higher ESG score from the outside looking in. It's a fundamental bias in the raw data that any smart quantitative manager has to figure out how to handle.
And size isn't the only thing that might be hiding in that ESG score. There's often a huge overlap with the traditional quality factor because, well-governed companies also tend to be really solid, financially robust businesses. Same with low volatility. A company with great risk management might get a high ESG score, but it's also probably going to be a less volatile stock. So when you see a high ESG score, what are you really looking at? It gets complicated fast.
So we've gone through the process, the exclusion approach, and the data-driven approach. Now it's time for a little reality check. Let's talk about the real-world trade-offs and all the nuances that investors have to grapple with. I think the most important thing to get is that building an ESG portfolio isn't like flipping a switch from bad to good. It's not that simple. It is a series of very active decisions, and every single one of those decisions has real, tangible consequences for a portfolio's risk, its returns, and its diversification.
So let's just quickly summarize the big challenges. First, exclusions have consequences.
If you decide to cut out an entire sector, like energy for example, that is going to dramatically impact your portfolio's performance and diversification. Second, as we've seen, the data has biases, like that size bias. And third, and this is a big one, correlation is not causation. Just because a high ESG portfolio does well doesn't mean ESG caused it to do well.
But here's the thing. These challenges, they aren't deal breakers. They're not reasons to just throw up your hands and walk away. In fact, they are the crucial nuances that separate a strategy that's just a superficial label from one that is truly thoughtful, rigorous, and intelligent.
Because at the end of the day, the goal of real ESG integration isn't about getting a perfect score or building a portfolio of corporate saints. It's about something much more practical. It's about building a more complete, a more holistic picture of the long-term risks and opportunities facing a company and, by extension, your portfolio.
And I'll leave you with this final question to think about. As this whole field continues to evolve at lightning speed, what do you think is going to be the dominant force shaping its future? Will it be the human values that gave us the very first exclusion screens hundreds of years ago? Or will it be the powerful, complex algorithms of the data-driven, quantitative world? That's the fascinating tension that sits right at the heart of ESG investing today.